We have to start with the one number that just flipped the entire market on its head today.
Yeah.
It was a classic case of bad news being great news.
Exactly. Private payrolls, they unexpectedly fell by 32,000 in November.
And everyone was looking for a gain. What was it, a 40,000 gain?
40,000 gain, right. So that miss immediately kicked off a massive rally in risk assets. I mean, the market basically took this as the final permission slip it needed from the Fed to start cutting rates.
You could just see it. The reaction was so visceral. And you can see exactly where that money flowed if you just look at the indices.
Oh, yeah.
The Russell 2000, which, that's the index for the smaller domestic companies, it just exploded. Surged, plus 1.91% to close at $2,512.14.
And what's so telling about that Russell surge is its performance relative to everything else. The S&P 500, the broader market, it only managed a plus 0.30% gain.
So it closed at $6,849.72.
Right. Which means the Russell outperformed the S&P by 1.61 percentage points. That's the widest single-day spread we've seen in weeks, and it tells you everything. The whole story is right there.
And the whole story is pure rate expectation.
Yeah.
We talk about the FOMC all the time, the Fed's rate-setting body. So what does today's data actually mean for their big meeting in December?
It means a rate cut is now seen as, well, almost a guarantee. Before this data dropped, the odds of a cut were pretty high, but now...
Now what are we looking at?
The implied probability has just rocketed to approximately 87%. 87%. That is the defining number of this whole session.
Wow. That is a massive shift. And it takes us right back to the catalyst. Let's unpack that ADP number, that minus 32,000 decline. It wasn't just a miss.
No, it was the steepest loss we've seen since, I think, March of 2023. And what's fascinating is where the pain was.
Go on.
The market's interpreting this as a positive, right?
Right.
Because it forces the Fed's hand. But if you look under the hood, it is a really tough picture for the smallest companies. The weakness was overwhelmingly in small businesses.
How bad was it?
They shed a shocking 120,000 positions.
Wait a minute. Small businesses shedding 120,000 jobs. That doesn't sound like a soft landing to me. That sounds like a lot of stress. Maybe even a crack in the foundation.
That's the big question, isn't it? And it speaks to the market's mindset right now, which is just pure Goldilocks optimism. Yes, small businesses are buckling. They are the most sensitive to high borrowing costs.
But the market doesn't care.
The market is focused on the other side of the coin. Larger companies, the ones with better access to capital, they still added 90,000 workers.
Ah, so the net loss is seen as just enough cooling to make the Fed happy, but not bad enough to scream recession. It's the perfect amount of weakness.
Exactly. The weakness is concentrated right where high rates hurt the most. So it reinforces this idea that relief from the Fed will fix the problem, that the high rates themselves are the issue, not some deeper collapse in the economy.
So we mentioned that 87% probability for a December cut. To put that in context, where were we just a few weeks ago?
The shift has been profound. In mid-November, the data was strong, and that probability for a December cut was hovering around, only 22%?
22%.
To leap from 22% to 87% in such a short time just shows how completely the market has bought into this dovish outlook. And it's not just for December. The market is now pricing in about 90 basis points of total cuts for 2026.
A forecast for significantly lower rates. And that forecast, it always hits the bond market first. Walk us through that chain reaction again, because this is really the why behind the whole rally.
It's a textbook chain reaction. Weak labor data means a higher chance of Fed cuts.
Right.
A higher chance of cuts translates directly to lower Treasury yields.
Mm.
We saw what they call a modest bull flattening of the curve today.
Okay, hold on. Let's pause on that term. Modest bull flattening. What does that mean in plain English for us?
It just means that short-term rates, which are most sensitive to what the Fed's about to do, are falling a little faster than long-term rates. The 5-year Treasury yield dropped 4 basis points to 3.62%, and the 10-year fell 3 basis points to 4.068%. So the whole curve is dropping. That's the bull part, but it's more aggressive on the front end.
And that drop in yields is precisely why the Russell 2000, the small cap index, surged by almost 2% today.
Absolutely. The makeup of the Russell 2000 is key here. These smaller companies, they rely so much more heavily on domestic borrowing costs. They often have more debt or floating rate debt compared to, a giant cash-rich tech firm.
So when the forecast for rates suddenly drops,
Their entire profit outlook gets a massive, disproportionate boost. They become the ultimate winners of a dovish Fed pivot.
Okay, so let's move from the small cap heroes to the broader market, because there we saw a really clear picture of, well, contradiction. The Dow did well, up $408.44, that's plus 0.86%, to $47,882.90. But the S&P and NASDAQ are much quieter.
Yeah, up only plus 0.30% and plus 0.17%. And this creates what we call the breadth paradox.
The breadth.
We saw strong market breadth, so the rally was spread out, about 350 of the 500 S&P stocks were rising. That usually signals a really healthy, broad-based move.
But the paradox is that this breadth was actually hiding weakness where it matters most, in the leadership.
Exactly. You'd expect the biggest, most powerful stocks to be leading a rally like this, and that just wasn't the case today.
So what was happening there?
While the average stock did pretty well, several of the mega-cap tech leaders really struggled. We saw NVIDIA down 0.9%, Broadcom fell 1.8%, and Amazon dropped 1.3%. Even Microsoft, it managed to climb back a bit, but it wasn't exactly leading the charge. The money was rotating out of that big tech momentum trade and into these rate-sensitive, cyclical areas.
Which just confirms the whole risk-on story we've been talking about. The money was flowing into sectors that need a healthy economy and, maybe more importantly, cheap financing.
The sector performance today was a textbook signal of expected resilience. Energy led the pack, gaining 1.87%, with financials right behind it, up 1.34%.
Classic cyclical leaders.
Exactly. And at the same time, the defensive sectors, like utilities, they lag. They fell 0.32%.
So the market's interpretation seems pretty clear. This isn't a recession signal. It's a stability signal. The economy is still growing, but the labor market is loosening just enough for the Fed to ease up.
And you saw that confidence in the fear gauge, too. The VIX fell over 3% to 16.08. That confirms an improving appetite for risk. The market is just not anticipating a shock right now.
Let's shift over to the currency market, because the dollar's reaction was, it was a huge reflection of this rate cut story.
That's right. The DXY, the dollar index, it fell almost 0.5% to 98.9 euro, getting close to 1-month lows. This is the natural result of pricing in Fed cuts so aggressively.
U.S. rates go down, the dollar becomes less attractive.
Right. And it's just adding to its recent weakness. The dollar's now down, 6.87% over the last 12 months?
And that weakness meant massive strength for other currencies. Sterling had its strongest day in months,
up 1.09%, and the euro advanced against the dollar too, up over 0.5% to 1.1700.
So a weaker dollar usually gives a tailwind to dollar price assets, like commodities.
Yeah.
And we saw some truly explosive moves there.
We did. 2 industrial commodities in particular were absolute standouts today.
Let's start with natural gas. It was the firecracker of the session. It surged a whopping 10.11% to close at $5.01. That's near 3-year highs.
That was just a perfect storm. On one hand, you've got cold weather forecasts boosting heating demand, and on the other, we saw record LNG liquefied natural gas export data.
Record exports
hit 10.7 million tons in November. That's a 40% year-over-year increase. Just exceptional momentum driving prices.
And copper was right there with it. An equally impressive rally of plus 8.65% to $5.39. Copper is often seen as Dr. Copper, right? It's a barometer for global economic health.
And its rally was twofold. You had some immediate supply concerns, but maybe more important was this huge demand expectation coming out of China's green energy push.
The solar build-out.
Exactly. China's solar capacity surged 212 gigawatts in just the first half of 2025. That nearly doubles the pace from the year before, and copper is absolutely essential for all of that.
We did see a strange split in the crude oil market, though. WTI crude was up a bit, plus 0.48%, but Brent actually went down 1.54%. Why the divergence?
It reflects different worries. On one hand, OPEC Plus is holding production steady, which should be supportive, but on the other hand, you have these forecasts for big inventory builds coming in the next 2 quarters.
So too much supply on the horizon.
That expectation of a future glut is what's really pressuring the Brent price, even with everything else going on.
Okay, switching gears completely.
Yeah.
What about the crypto world? It often moves along with these big risk-on, risk-off days.
It mirrored the equity market's attitude perfectly. Bitcoin gained a solid 2.18% to $93,349. But Ethereum was the real outperformer. It was up 5.42% to $3,150.17.
Any institutional action.
Yeah, a positive signal there. The U.S. spot Bitcoin ETFs recorded a net inflow of $58.5 million on December 2, which is a nice reversal after a period of outflows.
All right, let's bring it all home and talk about the most rate-sensitive part of the economy, real estate, and the context we have moving forward, especially since that government shutdown made the data so murky.
Yes, the rate-sensitive real estate investment trusts, the REITs, they definitely advanced on the back of lower yields. Data center REITs were the clear leaders, with Digital Realty gaining over 2%.
And for consumers,
There's real tangible relief in the housing market. The average 30-year fixed mortgage rate dropped to about 6.01% APR. That is the lowest we've seen in months.
and that drop is a direct result of the market pricing in these Fed cuts. Now, about that murky data, we're leaning so heavily on this ADP number because of that 43-day shutdown. Is there anything else out there that pushes back against this dovish story?
There is one very important counterweight. We have the weak labor market, but the ISM Services PMI, which measures the huge U.S. services sector,
How'd that show?
it actually rose modestly to 52.6% in November, still expanding.
So on one hand, labor is softening fast, which justifies the Fed cutting. On the other hand, the services sector, the biggest part of the economy, is still growing robustly. That really is the Goldilocks scenario, isn't it?
It is the dream scenario. But that dream is about to face its biggest test. The market has gone all in based on this one ADP number, but we have two critical data points coming up that will either confirm this whole narrative or just blow it up.
You're talking about inflation and the official jobs number.
Exactly. We're waiting for Friday's delayed September PCE inflation data. That's the Fed's favorite measure. And then the big one, the December 6th non-farm payrolls report. If those two numbers disappoint, the whole story could collapse.
I think it perfectly sums up the day. A textbook reaction. Collapsing private payrolls triggered a huge risk-on rally, driven by the Russell 2000's massive outperformance. The market wants rate relief above all else.
It has overwhelmingly chosen the optimistic path. Believing this weakness means the Fed can ease gracefully and deliver that 87% expected rate cut. It's a huge bet on Goldilocks.
But the core question for you, the listener, is the real tension here. Is today's labor market weakness just the confirmation of a soft landing, letting the Fed step back? Or is shedding 120,000 small business jobs the first real warning of a much harder landing to come?
Because if it's the latter, those rate cuts are going to go from proactive management to reactive, panicked chasing, and that's the challenge ahead.
All right, I think that covers it for today. That's the daily consolidation.
And as always, remember, none of this is financial advice. We're here for educational and informational purposes only.
Absolutely. You have to do your own research before making any decisions. But if you found this breakdown helpful, hit that subscribe button. We are here every day after the close.
We'll see you next time.